Hello and welcome to the Plain English Finance Podcast, the podcast dedicated to helping you make smart financial decisions. I'm your host, Tré Bino, certified financial planner and chartered investment manager. I'm a financial planner with TC Wealth Management and Visa Wealth. For more information or to send in your questions, check out the show notes at trebino.ca/podcast. If you want to learn more about me, start with episodes 1 and 2. So let's get into this will be the 25th episode. Okay. So this episode was going to be the start of the investment series one.
Yep.
And I seem to be making a habit of this.
I know. I'm like, maybe you should just stop introducing them.
Yeah, but I feel like if I stop introducing them, then it's like I want some people to know what's coming, and then I proceed to do something else. So
yeah,
I don't know.
Keep you on your toes.
That'll be the next one. The next one will be the investment series. No, this one is I got home today, so today I spent my day at a due diligence event, where I was basically in a room of it's probably 30 planners or so, and I left very annoyed. And I kind of got home, and I was like, I want to tell you about my day, but let's do it on a podcast.
No, that's not what you said.
What did I say?
You walked in, and I always start talking blah 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 about stuff, and you're like, I asked how his day went, and he was like, I'm so annoyed, but I want to do a podcast episode. So I was like, you're gonna leave me hanging on that like crazy.
Yeah. So you have no idea what this is about, but
no.
So this is more for other planners, really. Okay, and then for the general public as well, because I think it's important that you know. So basically, the reason I'm annoyed is, so part of these due diligence type events is it was put on by as part of my dealer, and they try to like show best practices for like other advisors to try to kind of copy.
Yeah.
And this one person that they were interviewing, blah blah blah, I don't agree with the practice management, etc., etc. But ultimately, what I'm annoyed about is he made a comment about his planning that he does, and it's really retirement projections from what I could kind of gather what he was talking about, which is not the same as full financial planning, but retirement projections. And he said, I use 4% for everything. So 4% rate of return assumptions for everything. And so I said to him, it was right at the end, and I said to him, everything. Like, you use 4% regardless of the client's risk tolerance, regardless of any of that. Yes, 4%. That bugs me. And I'll tell you a little bit about why, but fundamentally, and this is an issue across this industry, and even like planners that I'm relatively close to have said this to me, that they will use a flat rate of return just for all of their planning, because in their words is that they would rather to be fair, at least they're underestimating, but they think I would rather underestimate than overestimate what the return projections could be for this said client. And I think it's lazy.
One thing.
The second thing is I think it does a disservice to the industry as a whole, because you are making decisions, whether you're underestimating or overestimating or whatever, you're making the assumption that just because it's easier for you or the clients are not going to be upset at the end of the day, or whatever your reasoning is, it is wrong. As a financial planner, you have a standard that you should be, not must, because but that you should be striving to for accuracy. And if you hold your CFP marks, you are expected to meet this certain level of accuracy. And the Financial Planning Association of Canada give us what to use. They give us the assumptions. And granted, I feel like I can make a pretty educated guess, but the fact is, when they're coming up with 4%, 3%, 5%, they're simply pulling it out of their butt. They have no backing, and that's the reason that I use the projection assumptions and I use them properly. Because if I am going to deviate from it, I should be able to back up why I'm deviating from it. And the reason that these individuals are deviating from it is because they feel like it.
Yeah. I was just going to say immediately when you said that, it is 100% I agree, the laziness thing. Like, same as this whole other episodes we've talked about a similar overarching thing that humans love to do. They want to create um there's a word for them, but I can't think of it. It's basically let's say you're on a sidewalk and the sidewalk goes around a park, and on the other side of the park is a garbage can. Well, often what you'll find is a treaded path through the park, right? Because it's easier to get from. Who wants to walk all the way around? There's a word for them, but I can't remember what it is. But humans love to do that. Same with the rules thing, where it's the way you make decisions and all of these things. It's people just want to say you should always pay down debt first instead of investing, or you should always do this.
All these hard and fast rules.
Yes, yeah. It's I don't want to think, which I get to some extent, that you can't maybe think. Some decisions might have to be made that way. But again, like you said, if you are a professional and this is your job and this is the expectation is that you would do this for someone, choosing to go the easy way in something like that, I disagree with as well.
Yeah. And it has other implications that I think a lot of people don't really get. But I want to read straight from the FP Canada guidelines what it says. So, compliance with the guidelines. In all cases, assumptions should be well documented with sound rationale and clearly communicated to clients with a written explanation. Okay, so first off, any assumptions, you need a sound rationale, right? So you need to be able to back up the assumptions that you're using, basically. Okay. Then it says, so the use of the guidelines can be disclosed using a statement such as projection prepared using the Institute of Financial Planning and FB Canada Standard Council's projection assumption guidelines. That's the easy way to do it. It's kind of the way I do it.
So is this writing notes about kind of thing?
No, when you're using financial planning software or anything like that to project out what returns could be. So it's basically saying,
no, I know that, but I'm saying for this stuff, it's when you're talking, I'm thinking about if someone tried to sue you. You would be you would go to your notes almost to be this is what we talked about. This is how I came up with this answer. This is how I.
Yeah, I guess to some degree.
Because they're saying, oh, this is sufficient to say, to document that FP Canada, whatever you're reading.
Yeah, it's just the standard is that it should be documented with sound rationale. So you can either say, hey, it was prepared with these assumptions and guidelines, and then there's a ton of information about how they came up with these assumptions or guidelines, or you come up with your own assumptions and you provide the information that to support these guidelines, right? So one or the other. But it does give deviation margins. So it says, next part, where appropriate, financial planners may deviate within plus or minus 0.5% from the rate of return assumptions and continue to comply with the guidelines. So if it is outside of that, you are not complying with the guidelines provided by FP Canada. Okay, so you either think you're smarter than them or have more time or more, whatever it is, or you're wrong.
There's only two options.
Either you've done the research to back up why you think that you should be doing it a certain way, or you might think you're doing what's right for the client because you want to feel that way, but you are not.
So
simple as that.
Basically,
I don't care who you are. Doesn't matter if you have 500 years of experience. Doesn't matter. Either you go put together your proof of why you're coming up with the numbers you're at, or use what's being provided for you.
Yeah.
There's no and yes, maybe the number comes out to roughly the same. It doesn't matter. It doesn't matter that it's 4% or 5% or 3%. What matters is the route that you took to get there. Mm-hmm. Were you being honest? Were you being transparent? Have you done this properly? Have you done your due diligence?
Yeah.
Because blanket saying, and yes, maybe basic financial planning, not even planning, basic retirement projections when all you have is an RSP, maybe it doesn't have that much of an impact. But it has a huge impact in when you're looking at my world, when you're looking at the corporation stuff, the types of income matter a lot. The types of returns matter a lot. The amount of unrealized capital gains, these things matter a lot to the overall outcome. They will completely change the decisions that you make. The how I would recommend somebody accumulate wealth with a corporation changes completely based on their risk tolerance and their expected rate of return and the type of income that is being earned in this portfolio. And by just blanket saying, oh, well, it's being conservative, I'd rather be conservative than, because I think I can promise you that they are not being even close to correct. So here we have, based on the examples, the way that you figure it out is you have everything has a rate of return assigned to it. So for 2025, so everyone can Google this. If you type in 2025 projection assumptions, FP Canada, Financial Planning Canada, it'll bring up the document.
And this is what they projected, or is this like the rate of return over the year?
This is what they're projecting. So they've used, and they have how they come up with these projections, but they take like a 50-year average, they look forwards, they look backwards, and then they come up with these projections, basically.
Okay.
For us to use when you're doing long-term planning 10 plus years away, when you're trying to figure things out. And it gives us inflation, short-term fixed income, Canadian equities, US equities, international, emerging markets, give us a borrowing rate to use, a YMP growth rate, like government figures to use, probability tables for survivorship, like how long you're going to live depending on how old you are. But basically the way that you do it is you take the allocation that you've given to the client and you figure out what the return is going to be, and then you take away the fees. And this is why when people say, oh, I think I'm being conservative and etc., I almost promise that you're not. So for example, the example that they give, illustrative example only gives a 50-50. So 50% of it's in fixed income, 50% of it is in equity, and the total return comes to 4.9%. Then they had to deduct fees. So this person put 1.3, and so they get to a net return after everything of 3.6%, right? For this 50-50, like 50% in fixed income, 50% equity portfolio.
Yep.
Well, if I'm using 4% on everything, well, then
not being conservative.
I'm not being conservative. If I'm using 5% on it, I'm not being conservative. If I'm using 3%, but my fees are 2.5%, I'm not being conservative, right? So it's a case of, yeah, maybe you think you are. Maybe the returns have been pretty good over the last 5 years. If you're going to call yourself a professional, be a professional.
Okay, I have a few things to say. So I don't even know where to start because I'm having all these thoughts. First of all, this doesn't seem that hard.
No, it's not. It is not at all.
This seems like, but like there's lazy, and then there's like, go to this website, find the number, and then subtract your fee. Lazy. Like that's what it sounds like to me. As
there's a little bit of math involved, but I'm pretty sure in an hour I could build a calculator for this that does it just for me. And the financial planning software does it all for you. Like you can go set your rate of return expectations and it's all there, but they'll go in, override that and just use 4%.
Oh my gosh.
Like literally it's all there. It's all there. They choose
that almost seems like
wrong.
Yeah. It's
to not use the software because it's in all the softwares. It's in them all. But you can override it. There's a box you can tick and you can put whatever you want in there. Well,
why? I don't understand why.
Laziness.
But that almost seems like it's not like it is, but it's like, again, I guess it's like mental laziness because either they don't want to learn the software or like, it's like, oh, I'm just going to tick this box because that action is easier. I don't know. It just seems like it's still almost the same amount of work. It's almost It's like, imagine you have to do like a code to override it. And like, well, I don't
No,
know.
it's I think it's less mental. Yeah, I think maybe you're right. It's less mental work. It's also people think that they know it all, right? Like,
Yeah.
and I mean, don't get me wrong, I have a certain level of ego built based on I don't know everything. So there is still lots of stuff that I will go in. I will check my calculator for
Mhm.
basic mathematical stuff because it's not worth it me just doing it in my head when I can be for sure of the result.
Yeah.
If I'm trying to think of a number and I'm trying to think of like a government number that changes a little bit, I will just look it up, right? Like
Yeah.
it's and when it comes to creating return projections and stuff, some of this I think maybe it's a little conservative. Who cares what I think? This is the standard that is set. I hold the profession to a very high standard. I'm going to use this standard until, as a profession, they decide that it is a different standard to use. When I'm looking at the people that put this together, and I'm looking at uh, these these people with engineering backgrounds and PhDs and this and that and this much experience and like
So it's
I'm
like
gonna
a,
turn around and say that I know better than these guys.
that's what I was going to say. So it's like a group of people who come to a
Yeah,
consensus saying this is the best way to do it. But instead, it's some.
based on all of this data, based on all of this, and I know because you'll probably recognize one of these names here because you've seen me watch his
Oh,
stuff quite a
yes.
bit.
Yeah, I know.
Like, and so we're talking about engineers, the guy just straight up nerds that that spend their time pouring through the data. Yes, I'm gonna trust them over my personal judgment because while I think I am pretty good, I don't spend every day doing this.
Yeah,
This is not what
absolutely.
I spend this time with clients. I spend this time with other financial planning aspects. I don't do it figuring out what projection assumptions are reasonable.
Yeah.
So it bugs me when people and what bugged me the most about this is this guy was standing in front of a room of other advisors basically, and he was being shown as the like this is the example. This is a great example to follow. And I'm just the whole time thinking, are you kidding me? Like this is not okay. I'm not okay with this. Clients should not be okay with this.
Yeah, but they won't.
They
They
don't
don't
know.
know.
Of course they don't know, but it's on everybody else to hold you to a higher professional, a higher standard, and you're there openly saying, "Hey, I'm lazy in my financial planning," and I just because and the excuse of, "Oh, it's I would rather be under than over." You don't even know if you're under or over. Like, yeah, 4% might be conservative. I also think that is conservative. Not to a fixed income investor, that's not conservative. No, like to what? You can't just blanket everybody with the same brush because the results are so different. It makes a huge difference. And yes, you can run variance models and etc. To but you're garbage in, garbage out. If you're putting garbage into your program, programs are great. But if you're, it's just it, it bugs me. It bugs me. It
Um,
really does. And it's just like do it properly. Do it properly.
so what did you say to this guy? Did you call him out?
I said you really use 4% for everything. And then somebody else chimed up and saying, well, I do the same thing. I use 3% for everything. No,
Wow.
no,
Okay.
stop.
The other
Then you're
thing,
wrong.
the other thing I wanted to say is, so this event was a due diligence event,
Yeah.
and they had this guy up there. Do people not understand the rules? Like these people are.
I actually think they don't. So I had a conversation with somebody else and he said the same thing. I use a XYZ event and he gave like again, it's not about the reasoning, right? Like the reasoning makes sense. I would rather be under than over. Great. But we have guidelines. We like as a profession, we are given guidelines.
Yeah.
Use them
Yeah.
because you don't the process of you figuring out what the return rate expectations are and the reasonableness of that will stop you from making major mistakes because they will always people that use these type of numbers they'll always go to well I've seen a plan where the guy used 9% because that was what he had got over the last 5 years. Guess what? It didn't work out. Correct, but that's not what these guidelines are about. The guidelines are about giving us a consistent way to make accurate, high quality decisions and help clients come to those same conclusions. If you are choosing to ignore a major input into when you're running projections and running possible scenarios, how could you possibly say that you have enough information, or you're doing enough to guide your clients to optimal outcomes? How could you possibly say when you're just ignoring a major part of the decision making process? If I am a planner, or I'm like a client, and I'm seeing a planner brush everybody with the same brush, for everybody gets the same, like, you are wrong. You are wrong, and you are doing your clients a disservice. You should not be doing that. And if you are doing that, then again, what was the standard for the council? What did it say? It was, then you had to make sure that you reasonable expectations, and you document how you came up with these expectations.
Yeah.
Well, you gonna put a picture of your butt on there? This is where I pulled it from. Like,
oh my gosh.
it is so frustrating, because it's like and they see nothing wrong with it, and it's just, are you kidding me? You hold yourself out to what stat? Like, you think you're just better than, like, that. That's the only way that I can rationalize it. That you genuinely think that the people that sit here poring over this and putting these together, and the group that comes together and comes to a consensus, you think that you're superior to them.
Yeah.
And you think that you have more time on your hands, and maybe you could come up with a good idea.
It doesn't matter.
You have, with what time?
Yeah. And why?
Then put it together. Then put it together and prove it.
Yeah, I was gonna say, like,
coming up with numbers.
I can barely get a word in right now.
Sorry.
I just keep trying to interject, and you're like, Tré can rant sometimes. But I was just gonna say, I think I lost my train. No, there's nothing in there. It's like once I realize it's gone, it's gone. You can cut the cell out.
No, you're just saying in there. Because one of these things is, again, people will say, well, I'd rather be conservative. You know, that's a constant thing. Like, they'll adjust the CPI rate, and they'll, like, the inflation rate and things like that. You do, like, when we are looking at planning, we put in our assumptions, and then we can create scenarios with these variances in there. So we can turn around and say, okay, well, this is the reasonable assumptions. What if it makes more? What if it makes less? What if inflation is high? What if inflation is high, we have a market crash, we make more, and Bill dies? We can look at all of those outcomes. But what you are losing the ability of is saying, this is what is reasonably expected, and then now I'm making these variances.
Yeah.
Because you're not seeing, you have garbage in. So
you started
with it.
Yeah.
So yeah, while personally, like, what is the CPI? And the thing is, it changes. The assumptions change based on what's happening in the world. So, like, the inflation rate is 2.1%, right? Is the long-term inflation rate. I think that is low. Guess what my inflation rate is on my plans? 2.1%. And then if I'm talking to the client and I say, I think this is low, I will show them this is what happens if inflation is 0.5% higher.
Yeah.
I can show them that and say this, and they know that this is what could happen. I'm not just gonna bake it in there and not, like, it's just, I think it's intellectually dishonest, and it is a bad thing for end clients.
Yeah.
End clients. If you are going to a financial planner, you want it to be consistent, and you want to know what you're getting, and you want to know that the person that is sitting across from you is using good information. Sorry.
Okay, in this episode, Tré will talk. I'm just gonna go to the other. Anyways, I was just gonna say, I'm definitely the type of person who would ask a planner these questions, and I'm really interested to know what a planner would say if they're just putting, like, the garbage in. So it's like, because I remember when I asked you, like, oh, what if, like, if investing in equity is so good, like, what if the person is going to retire in, like, 5 years? And you were like, oh, well, we plan for that, like, this. And it's like, But I would ask those like what if questions you were saying. Well, what if like Tré dies and I need this and what if this happened and I don't know why I said you die. I don't know. I think because you said Bill died earlier. Anyways, maybe you should just start talking.
No, you've made it a point now. What's your point? You need to come to a.
Just that I would wonder what the advisor would say, because if they're like, okay, let's just throw in this number, it's like lower than, because I've heard people use like different rate of return numbers, right?
Mm-hmm.
And like in the content you watch sometimes, and I think people say 6, which is like probably average or whatever. Like that's what I hear anyways.
Yeah.
I hear that a fair amount. So saying 4 is, somebody would be like, oh, that's 2% less than average. But anyways, I guess my question would be, if I'm a client and I go in to talk to my advisor and they're like, oh, your projection for retirement is $2 million. It's like on the pace you're going, I would be like, okay, well, what if I wanted to actually retire 5 years earlier? Or like, what if I wanted to take an extended maternity leave of 3 years? What if then?
What if that?
Like things like that. Like, I guess now you're getting to the point where, like you said, I hope somebody is listening to this and saying, hang on, maybe I should be asking my advisor more questions, because you're not getting the right answers to those questions either.
Yeah.
And then it's like, again, what am I paying for? Like literally I'm paying you for this. I guess that's what I view it as. Like the planning side is so important, and being able to ask those questions and get answers back that you're like, obviously nothing's going to be 100% because everything's in the future. Like the
No,
future
for
is,
sure.
but it's like to get an idea, you know,
Yeah.
like, and once you start messing with that number a lot, those answers aren't right. So then it's like you're making these life decisions on numbers that aren't accurate, I guess.
Yeah.
Nice.
Yeah. And I mean, that's where, but if you ask somebody like that, they would say, well, I'm being conservative. Like the number I'm giving you is conservative.
And I guess to me,
And
I'd
my
be like,
question
okay, yeah, sure. That sounds
would be,
good.
why is it conservative? Like, why is it conservative? Because if you're being conservative, tell me why 4% is conservative, right? What should the actual expectation be if you're being conservative, right? I would even be okay. With these individuals doing this, if they said, no, I actually I calculate the expected return and I reduce it by 1%, right? Because at least that way I could be on your side where I say, yes, you're being conservative, right? I would still say in the planning software, you should be using good numbers, and then you can show that if you get 1% less return, this is what it looks like. You can show that. But to say, I'm just being conservative, and you have no idea what the baseline is, you have no idea if you're being conservative or not. Zero idea. How do you know?
Okay, again, I just want to say, we already said, or I already said this, but this is a due diligence conference.
Yeah.
That I don't know if I should say.
Say what?
Well, someone is hosting this event.
Yeah, Viso's hosting it. It's a Visa hosted event.
So they chose this guy to interview, and they were like okay with what he was saying, or?
Well, I don't know if they vetted what he said. I'm telling you,
I don't want to get anybody in trouble.
No,
is what I'm saying.
Yeah, today I already asked way too many questions, I think, for the people's liking. But yes, and the thing is that the investment side is different than the planning side. So that was a side of the mouth comment that wouldn't have garnered any attention unless you're somebody like me. That you're just like, hang on a second. What do you mean you do everybody at this rate of return? That is, and I will be completely honest, that is what I did at the very beginning of my career when I was learning from somebody else that also did the same thing, right? So I know it is a thing, and I know how easy it is to, if you're learning from somebody, this is what I was taught, use this rate of return. The world has changed a lot in the last 5 years, let alone the last 25 years.
Yeah.
So yes, maybe 5% was a balanced fund at that point in time, and you can, that was what you was using. Great. Things change. Are you keeping up? Well, if you're not keeping up, how do you know if you're keeping up or not?
Yeah.
You don't. You don't know if your numbers are conservative based on what's happening in the world today. You have to do the math. You have to do the math, figure out what the expected rate of return is, and then say to the client, hey, I'm really conservative, so I deduct 1% from this. This is what it shows. And I use Conquest. So you can go in there and say, this is the scenario, minus 1% from the rate of return. This is what it looks like.
Yeah.
But the issue is that the numbers would be much lower than I think people expect when you add in the cost associated with them. Because, I mean, this is a 50-50 portfolio that is coming in at, if I was to say 1.3 is low. So if I say the average mutual fund for a bank fee is 2%, it means that a balanced, like if you're working at a bank and you have your fund, your money in just this type of 50-50 portfolio, it means that your return projections are going to be 2.9%. Wow. Seems like a lot of hassle to go in for 2.9%. Right?
Yeah.
But that's what the return projection that you should be using if your clients are in a 50-50 portfolio and the fee is 2%.
Yeah.
So you're telling me that you're being conservative by using 4?
So this is what bothers me with like I'm not trying to what's the word? Sorry, I'm a little brain dead tonight, obviously. Stereotype a group of people, but sometimes older people in the industry will say I have a lot of experience, right? And to me, like, experience doesn't equate outcome, I guess.
Give a lot of experience doing something wrong.
Exactly. It's like just because you haven't gotten caught or just because nothing bad has happened doesn't mean, do you know what I'm saying?
Yeah, doesn't mean you're doing it right.
And I guess that's what freaks me out with working with anybody. It's like, oh, this guy has been doing this for 30 years. It's like, yeah, but are his clients actually better off? Was he accurate? And I guess in this industry, I can't imagine. I would get very overwhelmed trying to pick an advisor.
Yeah, me too. I agree, because it's very difficult to know the difference between advisors are, and
somebody saying the wrong thing confidently can come across.
Absolutely. This guy was so confident. So was the other person that chimed in. So confident. But no, you are objectively wrong. You're wrong. And it's just a case of, I wish, I don't know how many other people it would take to tell you that, but I mean, honestly, I would say though, being part of FPAC, the Financial Planning Association for Canada, has definitely elevated my standard that I hold other people to, but that I do for myself, because you have other people out there that genuinely, I mean, some of the guys that put this together are part of that group, right? So it's like you get almost like I would say, yeah, it elevates your standard, where you realize the importance of being accurate with data.
Mm-hmm.
And the assumptions is one of those things, and I just think it's lazy. And I know it will offend people. Do a better job. Ultimately, it's just like I hold it to such a high standard that it's like, it's not difficult. We have all the assumptions, or drop your CFP marks and stop using them.
Yeah, honestly,
you're not actually doing what you should be doing.
Yeah.
So if you're like, oh, I wouldn't want to do that, well, then it's very simple
to go be a salesperson.
Go work
at a bank.
Like don't hold yourself as a. And again, it's not even about the number that you come up with. It's the fact that you don't even know how you came up with that number, and you have nothing to back it up.
Mm-hmm.
Nothing to back it up. So like it's just, you don't. Even like these life expectancy tables and things like that, it's like when you're saying to a client, okay, well, I'm okay to plan until you're 80 or whatever it is. And I think that's less. I think planners that are trying to do the right thing don't do that so much. But I do think that there's plenty of planners that are trying to do the right thing that just come up with return expectations and ultimately are doing a disservice for.
Sorry, you kind of lost me there. So the life expectancy is like, oh, the average male lives till about this.
Yeah.
So when you're planning, you would put that number in.
Yeah. So here you can see like the probability of survival. Mm-hmm. So if you're currently 60 years old, you have a 10% chance if you're male to hit 98, 10% chance if you're female to hit 100. And then you can keep going across. So you have a 25% chance to hit 94 and 96 respectively, and then 50% chance to hit 89 and 91.
Right.
So again, where you want to pick on this scale is more subjective, but something
Like
that's
what?
accurate.
I just don't understand why people are like, I guess it's, yeah, there's no other word. I feel like we're going in circles a bit. We should wrap this up. But I was just going to say, all this information is given to you.
Use it.
On like Trey just showed me a PDF of this chart. It's like, just open the PDF, print it out and leave it on your desk every year.
Maybe
it changes, but.
Yeah, but that should be the standard, right? There needs to be a consistent standard. So
that's what I was going to say really quick, is that people love to like get stuck in their ways almost. And it's, this is the reason why a concept that's really important to us, I've realized as like time has gone on, is the people's willingness and ability to learn things. Because I don't care if you can sit down, take a ton of time, learn a software finally, and then you're like, okay, nobody touch anything. And this is exactly how we do it. And we need to use the green pen and blah, blah, blah. No, you have to understand it and be able to adapt to it and change it. You have to be able to change it and know it well enough that like things can change. Like these softwares that have updates and things like that. Yes, it's annoying. I get that. I also don't like it. Like
ultimately you're trying to do what's best for the client, and best for the client is
you have to constantly be learning.
Yeah. And as new technology comes out, but I was just quickly saying, so the projection period, first line, it is recommended to assume a projection period for clients where the probability of outliving their capital is no more than 25%. So it shows you here, 25%. So if a 20-year-old female comes into your office and you're trying to project things out, you should be projecting out to at least 98 years old.
Wow.
Right? And it goes up. So it's in your 90s, right? It's slightly under 95 for males, slightly over 95 for females. What number are you using? Well, if you're just picking the same number,
you're like, my grandma was about 81 when she died.
Without reason to back this up, you are doing your clients a disservice.
Yeah.
Simple as that. Your job is to do it accurately as possibly can, because it is so inaccurate in nature.
Yeah.
So if you're just choosing, it just, But
there's giving your clients an idea, and then there's, like you said, just pulling something out of thin air and making them pay for it. Basically.
Because it's like
just ask Chat GPT at this point. Like, I mean, I shouldn't say that because that's not. Don't do that. Just don't listen to me.
But yeah, that was my rant. It was just okay. So I hold this profession to a very high standard, and if you're holding yourself out as a financial planner, you should be. What standard are you meeting? And FP Canada have provided that standard. If you then choose to ignore that standard because you think you know better,
you're not compliant.
You're not. You have agreed to a standard.
Yeah.
You've said, yes, I am following this standard. If you do, why then drop your marks and go do whatever you want to do. Don't bring down the rest of everybody else.
Yeah.
Right? Like it's like the same way that person that did a crazy high number and ruined that, just their thought process was probably the same as yours. It's just that they were wrong. They were more wrong than you are, right? Choosing 7% or 8% or whatever as a long-term projection number. It's like at the end of the day, your process was wrong to get to the answer.
Mm-hmm.
Fix the process. So that way, when you're talking about how do we control risk when we're building financial plans, you ensure that the process for you to get the numbers is accurate and correct.
And repeatable and all those things.
And that will fix a large part of the risk of you having too high of projections or too low of projections and people underspending, right? If somebody comes to you and says, hey, can I afford this $50,000 trip to Disneyland? And you say, based on your projections, you can't. And they don't do it. And in reality, they could have, with reasonable projections, made the decision that, okay, it's worth the risk. And they don't do that, and they miss that out on that planning trip or whatever, that family trip. That's on you as a planner. It's on you. You screwed up. Yeah. Anyway, we should probably wrap this up because I can keep going on forever.
Yes.
You can tell I just.
I'm sure we're going to keep talking about this after we hit stop.
Yeah. Very frustrating. And people say it with such confidence, such like, yes, I do it this way. This is the right way to do it. And you're like, what?
I think the thing that really sucks is that you mentioned it, that people are going to be like offended, or like sometimes you get a bad rap that like because you like to question things, and like you do push people, and especially when someone's wrong confidently, I definitely see something in you that's like, you can't just sit back and be like, oh, you have to be like, that's why I said, what did you say? It's like ain't nobody getting away with that with Tré. No.
I said something. Well, I just can't imagine literally standing up in a room and other very impressionable planners that's all they know and they haven't been told any different, and confidently saying, hey, yeah, I like to screw my clients. That's not what they said, but like that's ultimately what happens. Is negligence. I think that's negligence.
Yeah.
There's a duty to you being right, you being as right as you can be. That's actually one of the, with FP Canada, that's one of the provisions is like the professional, like a making sure you're as accurate as possible and things like that. It's like you're just completely ignoring one of the biggest impact makers for financial planning. You're just coming up with your own rate of return assumptions. You have a different rate of return assumption if you decide to go, if you working with a client that's 90%, 100% equity, but 90% of it's in Canada and only 10% of it's US. Completely different return. And, like it's, you have these different assumptions based on how you're invested, the allocation, where you're invested, and just ignore that. All of that, just ignore it all.
Who needs that info?
Who needs that? Yeah,
I guess what I was going to say is that the thing that sucks about it is that when someone like you walks into a room and someone like that is standing at the front of the room saying, this is what I do, and I know what's best, and I have this much experience.
What he said.
I know,
yeah,
but you kind of, that kind of vibe, like that's the vibe. And you stand up and you're like, you're wrong. I've seen this happen before. That's why I'm saying it. People will be, oh, this guy thinks he knows it all. I'm like, this guy, people almost frame it that you have the ego. And I mean this like generally, not just you. I'm just saying in a situation where it's like somebody questions something. I've seen this happen in workplaces and teams I've worked on and things like that. Someone will be like questioning and kind of pushing the status quo a little bit. Hang on, just because everybody's doing it doesn't mean that's right. And you'll push and everyone will be like, oh, this guy thinks he knows it all. And it's actually, you think you know it all. And it's this weird like backwards cycle thing. It's like because you're doing this wrong and you're choosing to ignore this information or not learning because you think you know what's best. Anyways, it's not a very important point. It's just kind of interesting how I just don't want anyone listening to this to ever get that from you. And I don't think you portray it, but it's like
no, I think sometimes I might portray that, but the issue is with the subjects like this, for instance, my perception is much bigger than just, Saskatchewan, right? I'm part of like committees for FP Canada, right? Like when I'm talking about these type of subjects, I'm talking with really high quality planners from across the country. When I'm talking with for FPAC, for Financial Planning Association for Canada, it's like I'm meeting with incredible planners that have built very successful firms outside of the banks and like outside of all of that, like independently, and work with some of the biggest families in Canada that have dedicated themselves to their craft of financial planning. So it is not me. It is that I'm not the one saying, hey, these are the guidelines. I'm not coming up with these projections and these numbers, but they have impressed in me the importance of me not coming up with my own numbers. Right. And me not just making things up based on my anecdotal experience. So it's very important for the profession as a whole to be held to a certain standard. That standard is provided, meet that standard. Right. I don't have to do the hard work and try to figure out what Canadian equity could be performing in the future. It's provided. Use it. Use what is provided. So anyway, The next episode will be on...
What a smooth transition.
The next episode will be on the investment series. We'll talk about the basics, some options, and what people should know before making those type of decisions.
Okay.
Okay. Well,
we'll see you in the next one.
Bye.
Bye.
Oh, boy. Thanks for listening to this episode of the Plain English Finance Podcast. Tré Bino, Certified Financial Planner, Chartered Investment Manager, is a financial planner with TC Wealth Management and Aviso Wealth. You should always consult with your financial, legal, and tax advisors before making changes. This podcast is provided as a general source of information and should not be considered personal investment advice or solicitation to buy or sell any securities. The views expressed are those of the individual and are not necessarily those of Aviso Financial Inc. Mutual funds and other securities are offered through Aviso Wealth, a division of Aviso Financial Inc.